Candle range theory stands out as a strong approach in trading, but often, traders tend to overcomplicate it during real market situations. In this video, we're going to break down the CRT model in a clear way, go over the logic behind it, teach you how to identify it accurately on your charts, and share the most effective CRT trading method. If that sounds like your thing, hit that like button to support the channel. See you right after the intro and disclaimer. So, what is candle range theory all about? Candle range theory, or CRT, is a market approach that examines the high to low range of an individual candlestick on a chart. The basic principle of this theory is that every candle marks a specific trading range. When you zoom into smaller time frames, you'll often find that the candle's high and low serve as key reversal zones on those lower time frames. These areas highlight critical liquidity zones, the peak and bottom prices reached in the last trading session. That session could span a day, a week, or even just 1 minute. Now, let me walk you through how using this single candle concept alongside smart money principles can lead to highly probable trade setups. This method typically revolves around a 3-candle setup, where each candle serves a specific purpose. The first candle sets the range. The second candle performs the sweep. The third candle offers the entry point. Let's go through each part of the concept in detail. We begin with the first candle. Candle range theory proposes that the high and low of any candle mark significant liquidity zones, which the next candles often aim for. If we dissect this candle into a lower time frame, we'll often see that its high and low serve as pivot areas on that smaller scale. In the case of a daily candle, these points represent the most actively traded high and low of the day, highlighting their importance. That means, without diving into lower time frames, we can still locate major liquidity zones just by reading one candlestick. The top of the range is referred to as the candle range high, CR, and the bottom is known as the candle range low, CRL. This logic applies across all chart time frames and to any candle we see. However, not all candles are suitable. Later in the video, we'll explain how to identify the right ones. Now, when the second candle pushes past the CR high and quickly pulls back, there's a strong chance that price will aim for the CR low next. To put it simply, this sweep at the CR high implies the market could reverse and head toward the liquidity sitting below the range. If instead the second candle closes above the CR high, the CRT setup becomes invalid. That's because the market is more likely to trend higher instead of revisiting the first candle's low. But when the criteria are satisfied and the second candle fails to close beyond the CR high, we can anticipate a third candle entry opportunity, this time, potentially targeting the CR low for a short trade. That sums up the foundational logic behind CRT. Now, let's dive into the specific rules and walk through the actual steps of trading this concept on the chart. The first question that comes up is, which candlestick should you choose to apply candle range theory? If you've explored this concept before, you'll notice that a widely used method among traders is to monitor the 1-hour candle right before the New York session begins. Why is that? Because the New York session is known for its sharp reversals, particularly right after the market opens. It often begins by clearing out the liquidity built up during the London session and then flips direction. This pattern creates prime trade setups. Here's an effective method. Apply the CRT framework to the 1-hour candle that forms just before the New York session kicks off. If the price breaks beyond that candle's high or low and then re-enters its range, you're looking at a classic CRT setup that also fits with the behavior commonly seen during the New York Open. This combination creates high probability trade opportunities, provided your entry timing is accurate and you manage risk properly. But there's a challenge with this method. You're trading counter to the prevailing trend. Aligning trades with the trend gives stronger confirmation and increases the odds of success. So now the question is, can CRT still be used effectively while moving in the direction of the trend? The answer is yes. We've developed a strategy that merges CRT logic with trend-following principles. Let me walk you through exactly how this setup plays out. To begin with, we want the market to be clearly moving in an upward or downward direction. After identifying the trend, we wait for a pullback. This allows for a more favorable entry point and a logical spot to position our stop loss. Suppose the latest impulsive leg started from this level and extended all the way up to here. We anticipate that the correction will take place within this zone. At this stage, we start applying the CRT strategy, but only to bearish candles. Since the trend is bullish, we highlight the high and low of every bearish candle and observe how the following candle behaves. If that next candle drops below the range and manages to close beneath it, the setup is considered invalid, and no trade is taken. Then we repeat the same process with the next bearish candle. This sequence continues until we spot a candle that dips beneath the low but manages to close back within the range. At that moment, we've got a valid signal. Both the defined range and the sweep are now in place. The next step is, where should we enter the trade? A straightforward method is to buy immediately after the sweep candle finishes forming. However, there's a more refined and efficient technique. We can switch to a smaller time frame to locate a more precise entry opportunity. As an example, if we're analyzing the 1-hour chart, we can drop down to the 5-minute or 15-minute time frame. On these lower time frames, we gain better clarity. In this method, we look for fair value gaps that emerge right after the sweep. These serve as our entry points. So, the key is to wait until a fair value gap is printed and then set a buy order at that zone. Our stop loss is positioned just below that gap. For our targets, we can manage risk smartly by closing half of the position when the price hits a 1-to-1 risk to reward ratio. That way, if the price later reverses and reaches the stop loss, we've already locked in profits and the trade breaks even. We allow the rest of the position to run until price reaches a significant resistance level or area of interest ahead. Since this setup is aligned with the overall market trend, combining it with CRT gives us a strategic and reliable method to trade with momentum on our side. Now, let's go over the bearish version of this setup, and this time, we'll also introduce the concepts of discount and premium pricing. Now, we're integrating the idea of premium and discount pricing. In this scenario, the market is trending downward. We don't enter immediately. Instead, we wait for a retracement that lifts price into the premium zone. This gives us a stronger entry point and improves the likelihood of a profitable trade. Once the price moves into the premium region, we begin applying the CRT framework. But this time, we only consider bullish candles during the pullback. As before, we outline the high and low of each bullish candle and observe the reaction of the following candle. If the next candle breaks and closes beyond the range high, the setup becomes invalid. However, if it sweeps the high and then closes back inside the same range, we have a valid CRT opportunity that matches the overall bearish structure. To refine our entry, we switch to a lower time frame and wait for a fair value gap to appear just after the sweep occurs. We then place a sell order at that fair value gap and position our stop loss just above it. Once again, we lock in partial profits at a 1-to-1 risk to reward level and allow the rest of the trade to ride toward the next key support or liquidity level. By holding off for a retracement into a premium area before executing CRT, we effectively combine three core ideas: market trend, liquidity manipulation, and entry precision via premium, discount pricing. This results in a clean, intelligent, and high-probability strategy. Now that we've covered the proper CRT application, let's quickly run through some frequent mistakes traders make, and how you can stay clear of them. One major mistake traders make is applying CRT in a sideways or indecisive market where there's no clear trend. CRT is designed to work in trending environments where you can easily distinguish between impulsive moves and corrective pullbacks. Without a defined trend, liquidity sweeps lose their meaning and can lead to false signals. Another common error is entering trades prematurely, for instance, reacting solely to a price reversal. That alone isn't enough. You need to see a confirmed liquidity sweep followed by a candle that closes back within the original range. Always wait for the candle to fully close before making a decision. Entering before confirmation can lead to losses if the move continues against you. Additionally, many traders overlook the broader market context. Even if a CRT setup looks textbook perfect, it can still fail if it occurs right before major news or near a significant higher timeframe level such as a daily support or resistance zone. Always zoom out and understand the overall environment. By steering clear of these avoidable mistakes, you'll increase the reliability of your CRT setups and improve your overall performance. In the next section, we'll examine some real chart scenarios and demonstrate how we apply CRT principles in different market conditions. Here we have the EUR-USD pair on the 1-hour time frame. We're going to identify and evaluate every CRT pattern that appears throughout our backtesting session. Let's begin. The market recently broke above a significant swing high, signaling that bullish momentum is currently in control, a clear indication of an uptrend. That means we're focusing exclusively on long opportunities. To align with this directional bias, we'll apply the CRT model only to bearish candles, as they represent temporary pullbacks within the larger bullish trend. Here's our first corrective bearish candle. We mark its high as the candle range high, CRH, and its low as the candle range low, CRL. Our condition for a valid setup is straightforward. The next candle must sweep below the CRL, either with a wick or body, and then close back inside the range. However, if the next candle closes fully below the CRL, that invalidates the setup and we move on to the next opportunity. Now let's observe what happens next. The following candle does exactly what we're looking for. It wicks below the CRL but closes back within the range. This completes the first part of our CRT model. We have a range candle followed by a sweep candle. With this confirmation, we anticipate a continuation of the bullish move and begin preparing for a long entry. To refine our execution, we'll drop down to the 5-minute chart to identify a precise entry using lower time frame structure and potential fair value gaps. On the 5-minute chart, we can now observe the finer details of price action. This most recent impulse move swept liquidity and closed back inside the range, a key signal we were waiting for. At this stage, our next step is to identify a bullish fair value gap, FVG, to use as an entry point. If you look closely at this latest move, you'll see it has already formed an FVG, and price is currently rejecting from it. This gives us a solid confirmation to enter a buy position, with our stop loss placed securely below the FVG. As always, our trade management remains consistent. We close half the position at a 1-to-1 risk to reward level, and let the remaining half run, maximizing potential upside. Even if we miss this specific trade, notice how often price created additional FVGs during the move up, each one offering new entry opportunities along the way. This marks our first successful trade in this sequence. Now let's head back to the 1-hour chart and keep scanning for more high probability setups. Once again, we've got a clear bearish candlestick formation where we can apply the CRT model. We mark the high and low, then wait for the next candle to confirm with a close. And just like before, a liquidity sweep forms, so let's drop down to the 5-minute chart to find our entry. On the 5-minute time frame, we can see multiple fair value gaps, FVGs, already printed. We'll place a buy limit at the lowest FVG, since it lies in the discount zone, giving us a better risk to reward ratio and a safer stop loss placement. We'll manage this trade using the same exit strategy as the previous one. Now, let's see how it plays out. The price activates our buy limit, hits the first target, but then reverses and eventually tags our stop loss. Luckily, since we secured partial profits at the 1-to-1 level, we walk away with a break-even trade, no loss, no stress. Now, let's zoom back out to the 1-hour chart and continue scanning for new trade setups. Let's now zoom out to the 1-hour chart to look for more trading opportunities. Once again, we can spot a large bearish candlestick, which gives us the chance to apply the CRT model. The following candle sweeps the liquidity beneath the low of that candle's range, an ideal signal. With this sweep confirmed on the higher time frame, it's time to drop down to a lower time frame to pinpoint our entry. At this stage, all we're looking for is a bullish fair value gap, FVG, to form on the lower time frame so we can set a precise entry. Moving forward, we see a small FVG form. We place a buy limit order here, with a relatively wider stop loss to account for volatility. Soon after, another FVG forms. Rather than cancelling the first trade, we simply stack another buy setup. This leads to another profitable trade, showing how the model can play out in sequence. Now, of course, keep in mind, this was a backtest. We were fortunate to spot multiple winning trades, but that's not always the case in real market conditions. The goal here was to show how we consistently approach different market scenarios using this strategy. Thanks for watching. I hope you found value in today's video. If you did, don't forget to hit that like button, it truly helps support the channel. And if you're new here, make sure to subscribe and turn on the notification bell so you never miss any future content. Thanks for watching, and I'll see you in the next episode.